Hey everyone, welcome back to CryptoMania. It's November 11, 2025, and today we'll walk through everything that moved the crypto world yesterday. Price action, big institutional signals, regulatory shifts, minor and sector reactions, and what every investor needs to know right now. We'll go deep on Bitcoin and Ethereum price behavior, cover altcoin winners and losers, examine institutional flows and a notable FCA approval in Europe, and close with practical takeaways and a trade checklist. If you want the full breakdown automated into edit-ready segments, stick around. We've got timestamps and scene cues for editing. Let's get into it. Market snapshot and big picture. Start with the headline numbers. As of yesterday's session, the total crypto market was trading around the mid-$3 trillion range, with daily moves showing short bursts of strength and immediate follow-through selling, a market that's trying to find direction as macro headlines shift faster than last year. According to market updates reported on major exchanges and aggregated data services, the market cap hovered near $3.5 trillion yesterday, while intraday volatility remained elevated. Bitcoin itself moved within a choppy band, briefly pushing above the 106K mark before erasing parts of the rally and settling in the low 104K to 106K area during the day. That intraday flip-flop created whipsaw conditions for both spot traders and derivatives desks. Reports flagged Bitcoin trading near 106,200 at one point, then showing pressure into the U.S. session. Ethereum followed suit, with a constructive move, reclaiming and testing levels in the mid-3,500-3,600 band as network activity and DeFi flows showed pockets of renewed interest. But the overall tone remained cautious, money rotating in and out rapidly. Bitcoin technicals and narrative. Let's unpack Bitcoin's story because price action alone only tells half the tale. Yesterday we saw an attempt to push higher, but momentum stalled at resistance around 107K, 108K, and sellers re-entered the market, producing a pullback toward the low 104K zone. Several technical analysts caution that the daily structure still favors sellers unless Bitcoin reclaims and holds above the 108K zone on volume. One reputable chart service noted that the short-term downtrend signals could still be in play, and that failure to hold the 100K area would risk deeper retracement scenarios. At the same time, on-chain flows and ETF and strategy buying remain an important part of the narrative. Yesterday's activity showed both retail-led momentum and institutional desks executing block buys into dips. But, with outsized liquidation events and algo still sensitive to macro headlines, the net effect was a choppy range, not a clean breakout. The key metrics to watch over the next several sessions are 1. Buy volume at 100 to 106K, 2. Spot ETF net flows, are net inflows sustained, and 3. Derivatives open interest, whether shorts get squeezed or if longs are trapped. Ethereum and altcoin action. Ethereum's story yesterday was one of renewed on-chain activity. ETH reclaimed the 3600 area briefly, supported by increased smart contract interactions and fresh DeFi TVL movements. Traders pointed to improved staking yields and inflows into ETH-backed institutional products as supporting factors. However, when large macro headlines hit, ETH's correlation to risk-on flows caused the token to retrace quickly alongside Bitcoin. Turning to altcoins, XRP showed notable strength relative to the pack, with a jump that traders linked to ETF and regulatory signals. Markets increasingly priced the likelihood of institutional products for major altcoins. Solana had pockets of strength tied to NFT and gaming liquidity, but the AI token blowups and rotation into tech sectors also weighed on some previously high-flying alt names. Overall, altcoins rallied on optimism but lacked breadth, meaning fewer tokens participated in the move, and that's a classic warning sign before broader bear rotations resume. Institutional flows, ETFs, and Treasury behavior. Institutional behavior continues to be a decisive force. Yesterday, analysts reported mixed signals. Some spot ETFs and strategy funds showed intermittent buying, while other institutional flows exhibited profit-taking and reallocations, especially among treasuries and hedge funds trimming risk after October's big moves. Aggregators reported both inflows and outflows in short succession, underscoring uncertainty at the institutional level. An additional important development to flag: some corporate crypto treasuries and digital asset treasury managers are exploring smaller cap tokens and non-traditional yield strategies. Reuters and other outlets have highlighted this rotation into fringe tokens as a potential flashpoint. When institutions chase yield in low liquidity venues, price moves can be extreme on minimal flow. That dynamic matters. Institutional demand can both stabilize via large buy orders and destabilize via concentrated exits these markets. Miners, infrastructure, and sector rotation. Yesterday also highlighted the sensitivity of crypto mining and infrastructure stocks to sector rotation. As AI thematic flows cooled, and with some large cap tech earnings creating choppy tape, miners and ASIC-heavy names weakened, underperforming spot BTC even when price managed to hold higher intraday. CoinDesk and other market outlets flagged miner stocks tumbling as leverage and margin pressures hit their equities, which in turn feeds back into market sentiment around mining profitability and hash price sustainability. For miners and infrastructure operators, watch two metrics this week: energy costs and realized BTC after factoring in production sell pressure. When miners get squeezed, they can become forced sellers, which adds downside pressure at critical support levels. Now, a major regulatory development that's worth highlighting and which could have longer-term implications for institutional flows. On November 11, the UK Financial Conduct Authority authorized a new crypto clearing and settlement infrastructure provider, ClearToken, a firm backed by heavyweights including XDT Markets, Nasdaq, and Nomura interests. The FCA approval is a concrete sign that the UK is moving to build institutional-grade plumbing for tokenization and custody. And it comes amid a broader push by UK regulators to accelerate their review processes and enable safer institutional access. This kind of infrastructure approval matters because it reduces operational friction for institutions looking to scale crypto exposure. Why this is important for the viewer? Better clearing and settlement reduces counterparty risk, which typically lowers the premium institutions demand to hold crypto, and that can be bullish over a multi-quarter horizon. Still, approvals don't instantly equal inflows. They create the potential for more sustainable, larger allocations over time. Risk scenarios and technical warnings. We must balance optimism with caution. Several analysts published technical calls yesterday flagging downside risks if Bitcoin cannot hold the 100K psychological line. Some technical studies suggested a potential death cross-style dynamic or deeper retracement scenarios that could push BTC toward mid-70K levels in extreme cases if liquidity evaporates and leverage unwinds aggressively. Those scenarios are not base case, but they are possible and deserve respect. At the same time, there's a constructive case. Sustained ETF and institutional demand, plus improving UK and EU infrastructure, could keep the market afloat and eventually lead to a cleaner resumption of the bull trend. So we're stuck with a two-sided market, a path to higher prices if liquidity stays supportive, or a deeper correction if macro or liquidity shocks reassert themselves. Practical takeaways and action checklist. Okay, specific takeaways you can use right now. If you trade, keep stops tight, watch derivatives open interest, and avoid adding size into thin euphoric rallies. If you invest, DCA into core holdings, BTC, ETH, and keep a portion in stablecoins to buy dips. And cap exposure to high volatility altcoins. If you use DeFi, avoid new illiquid tokens where institutional players are routing yield-chasing flows. Prioritize smart contract audits and protocols with proven TVL. Watch this week's signals: ETF net flows, BTC 100K test, and any macro headlines about the US shutdown, interest rates, or currency moves. These are simple rules, but discipline is what separates survivors from those who chase headlines and get liquidated. Viewer Q plus community prompts. Quick community segment. I want to hear from you. In the comments, tell me, are you adding to Bitcoin at these levels or using this as an opportunity to rebalance into ETH or stablecoins? Which altcoin are you watching this week and why? I'll pick a couple of replies to feature in the next show. Also, if you're editing this for shorts, clip the top 3 takeaways and use the thumbnail BTC holds 106K, risk or opportunity. That tends to get clicks. To close, yesterday's action was telling. The market showed a tentative lift, but it's not a clean breakout. It's a market that's still listening to macro and institutional signals. Regulatory progress in the UK and inflows into ETH products are positive structural signs, but technical warnings and minor sector weakness are real near-term risks. If you found this useful, smash the like button, subscribe, and hit the bell. Share the video if you think someone else would benefit. This has been CryptoMania. Stay disciplined, stay curious, and I'll see you in the next update.